When you hear that the Federal Reserve raises or holds interest rates, it can sound like the Fed is directly controlling mortgage rates, credit card rates, or the stock market. But that's not what the Fed actually controls. When people talk about the Fed interest rate, they're usually referring to the federal funds rate. This is not the rate you see advertised by a bank, and it's not the rate households borrow at. The federal funds rate is the interest rate banks charge each other for very short term overnight loans. Banks borrow overnight because they're required to hold a certain level of reserves, essentially cash, at the end of each day. If a bank comes up short, it borrows from another bank that has extra reserves. The Federal Reserve does not set a single percent interest rate. Instead, it sets a target range and then uses its tools to keep short term overnight lending trading within that range. Suppose Bank A ends the day slightly below its required reserves, and Bank B ends the day with extra. Bank A borrows overnight, pays interest, and repays the loan the next day when customers make deposits, payments, and normal cash flow settle. That overnight rate is the federal funds rate. It's the base price of overnight money between banks, and everything else builds on top of that. When that base price changes, it changes how much it costs banks to borrow short term money from other banks. Over time, the short term base price indirectly influences other interest rates, like auto loans, credit cards, and adjustable rate mortgages. It also affects how willing banks are to lend versus hold reserves. What the federal funds rate does not do is instantly control inflation, guarantee economic growth, or directly set long term interest rates like mortgages or bond yields. While the federal funds rate can eventually influence those other rates, those rates also depend on expectations, global markets, government policy, and how households and businesses respond. The Fed rate takes time to work through the economy because it operates indirectly. Banks adjust lending, businesses rethink investment plans, and households change spending gradually, not overnight. The rate is a signal and a tool, not a dial that instantly adjusts outcomes. In the next video, we'll see why there's so much pressure to lower rates and why acting too soon to do that can backfire.